All right, everybody. Welcome to Second Common Strategies. It is Sunday, June 7th, 2026. This is the investing rationale for Medtronic, ticker symbol MDT, Mike Delta Tango, Medtronic. So as you guys possibly know, as going through our portfolio reviews, a lot of our portfolio is tied up in tech. I'd say about 42%. More recently, going back to, say, the last quarter of 2025, we did start to expand, at least for my tax-advantaged accounts, into some more retirement-type holdings, more SCHD, more dividend compounders. What I believe that I've identified here in Medtronic is at least a potential multi-year setup with a margin of safety that's offered somewhat through its decline in stock price. Before we get into the charts, just go ahead and take a moment, read through this. You can pause if you'd like. Essentially what it lets you know is that I'm not a financial advisor, and what we're going to discuss here is for information educational purposes, and it is my personal rationale for investing with my money. All right, so let's go ahead and jump into it. Medtronic at a glance. Medtronic is a trusted medical device developer. Been around since 1949, and they are a global partner for healthcare institutions. They're about 95,000 strong, headquartered in Dublin, Ireland, stateside Minnesota. They primarily operate from 3, maybe 4 primary segments. Cardiovascular, which in last year or fiscal year 2026 revenue was $13.98 billion, representing 38.4%, specializes in advanced cardiac rhythm management, transcatheter heart valves, stents, and highly innovative pulse field ablation systems. The second largest contributor was the Neuroscience division, which contributed $10.3 billion or 28.3%. Medtronic is a market leader in cranial and spinal surgical technologies, deep brain stimulation, and stroke care. Following that, we have medical surgical, which generated $8.8 billion revenue, 24.2%. They've advanced their hospital operating suites with surgical robotics like Hugo, smart ablation, and patient monitoring. And there is a fourth component here, their diabetes and other, which contributed $3.2 billion or 9.1% of their overall $36.364 billion in revenue. I would call out that is an 8.43% year-over-year increase, and 5.8% of that was would be considered organic growth. Here, one of the things I want to talk about, or just take a moment to talk about, is in their medical surgical area, Hugo. Like I said, they aren't just making pacemakers. They really kind of stepped up their game, and they've really been advancing some technologies. Most notably is Hugo. It's a robot-assisted surgery system. It's an open console, so unlike the traditional robots, it does allow the surgeons to actually wear 3D glasses in an upright position, so they are able to maintain direct visual contact and verbal communication within the operating room team. It features modular arms. It has 4 arms that can be used to fit specific patient needs, operating room layouts. And it's primarily used today for urologic procedures such as prostatectomies, with expanding clearances for gynecologic and general surgeries. It is installed in approximately 35 or more countries in South America, Europe, Asia, Middle East, of course, the United States. One of the early adopters was the Cleveland Clinic and Duke Hospital System, as well as Atrium. Let's take a real quick look at their geographic breakdown. One of the things that I like about Medtronic is one of the things that I like about Abbott, which is a similar company that we recently invested in. They're globally diversified. In the case of Medtronic, 51% of their revenue came from within the United States, which means that about 48.8% of it did not. The United States is their primary domestic market, and it's an anchor for their high margin things such as the pulse field ablation and the Hugo robotics, which we talked about a moment ago. 25% of their revenue came from Western Europe, where they're integrated into their single payer healthcare system, and they have consistent demand for their cardiovascular and neurovascular platforms. In Japan and Asia Pacific, 15% of their revenue share, or 5.45 billion in the preceding fiscal year, the growth is fueled by primarily aging demographics and advanced cranial, spinal, surgical tools, and some of their standard-setting pacemaker lines. And then in their emerging markets, which is about 8.8% of the revenue, or 3.2 billion, there is this potential expansion into these currently unpenetrated regions. As the global populations trend older over the next 10 to 15 years, I want to go back and talk about Japan and Asia Pacific specifically here. As that population trends older over the next 10 or 15 years, the baseline demand for spinal therapies, neurological cares, advanced cardiac platforms are only going to increase. So for an income investor buying into these global demographic tailwind like this kind of provides a bit of peace of mind. Okay, let's take a moment to look at the stock and how it's performed as of late. This is kind of when I talked about that margin of safety being supplied via the decline recent in the stock price. This is what I was referring to. So if we take a look here, year to date, they're down 14.98%. They peaked as high as 102 earlier this year, but then in a sharp downward trajectory, we do see a slight tick upwards here. That was a post-earnings bounce which occurred this week. So had I made the slide a couple days earlier, it would have been kind of at the rock bottom, but we see we've kind of dug out of that. Prior to that, they were testing their multi-month lows around 73.98. If we take a look at the 5-year chart here, they're down 34.06%. Yikes. I mean, that's a significant underperformance compared to the broader market. They faced valuation compression. The forward PE dropped approximately between 14 to 21 times, which kind of made the stock a bit cheaper historically versus their competition, additional or other medical device peers. To me, I saw that as a bit of a silver lining because, as we talked about before, when the stock price goes down, it can make the dividend yield, push up. So it's near historic high between 3.5 and 3.8. Of course, we understand the math behind it, but sometimes it's okay just to let the math kind of tell a story for us. Okay, so let's take a look at some of the financials here. Generally speaking here, not a whole lot to say. I would say that we are looking at a trend that goes up and to the right, not by any leaps and bounds, but if I look at revenue, which is in green, earnings in blue, or the free cash flow, they all do seem to be ticking up, even if they are somewhat modest. Taking a look at annual revenue and growth, we mentioned earlier that the revenue for the previous year was 36.4 billion, which was an increase of 8.4%. 5.8% of that would be considered organic growth. That is a 10-year milestone as far as the strongest annual top-line revenue growth in about a decade. And here in the Q4, they did 9.8 billion, which is an increase of 9.9%, which comfortably beat Wall Street estimates. If we look at our charting here, we generally see a trajectory that moves up and to the right modestly. We saw a dip here. Honestly, anything that happens between, say, 2019 and 2021, I just kind of call them the COVID years and keep it moving. But essentially what we see is a pretty standard move up and to the right here. Keying in on earnings and profitability, so for the full fiscal year, they reported $5.53 of non-GAAP earnings per share, which did beat their internal company expectations. As far as what GAAP or GAAP diluted EPS was $3.73, an increase of 3.3% year over year. Q4 adjusted EPS was $1.55, which beat the Wall Street consensus by a penny. And their adjusted gross margin of 65.4 was an increase of 30 basis points, driven by pricing power and manufacturing efficiencies. Let's take a look at the dividend overview. So their current dividend yield is 3.48%, between 3.45 and 3.48. That's approximately $2.84 a share. The 3-year CAGR is 1.45, 5-year CAGR is 4.13, the 10-year CAGR is 6.45. Their payout ratio is 75.96%. It's a little higher than maybe we would love, but at the same time, this is a dividend aristocrat on the very doorstep of becoming a dividend king. So about 48, 49 years in a row, they've increased their dividends. So I'll give them some credit in knowing what they're doing. Also, we do see that the free cash flow payout ratio is 67.19%. And I do like to see that at a lower number. It lets me know that the dividend is covered by the actual cash that's coming into the business. So it leaves a little breathing room to maintain that history of payout increases, which, as I mentioned, they've done for quite a number of years in a row. So when we look at dividend growth, what we see here is a nice little staircase here from 2016 to 2026. Basically, it's kind of what we want to see. It's when we're talking about defensive cornerstones for a portfolio. It's uninterrupted. It's just a beautiful staircase of increases, to be quite honest. We do see that maybe that some of these stairs aren't as tall as others, but the general progression has been up and to the right. We look historically to the yield on cost, and it kind of highlights the cyclicality of buying a steady dividend grower if you get in at the right time. If we look back here around 2016, the initial yield on cost would have been around 4%. The stock had rallied, as the stock rallied around 2021, the available entry yield had actually compressed and was down to half of that, around 2%. And currently it's sitting at 3.48% as we've had that stock price depreciation, as we mentioned earlier. We'll take a little more focused look at the payout ratio, and we see Medtronic's ratio, it hasn't been a smooth ride. We see some spikes around 2017, 2018, where it got all the way up to 119%. In 2020, it crossed 100%, and then in 2023 or so, it also crossed 100%. So it got well above those targets of 60 to 70%. Heading into 2026, however, we see the data does show some cooling factor. We see that it's moving kind of downward and kind of leveling off from, say, that 101 point around 2023 until, say, the mid or high 70s at current. Okay, so before we get out of here, what I'd like to go into is my personal investing rationale for why we're buying into this position. And we'll start with the financial forecast. Top line revenue growth, as we discussed, 38.17 or 4.96% increase is what's expected. Next year forecast is 39.77 billion or 4.19%. As far as bottom line expansion, earnings per share, this year's EPS is $6.06, and the next year's forecast is $6.52, increase of 7.66%. And what we want to see is that the top and bottom lines can support future payout hikes. Looking at the revenue forecast, Medtronic is expected to bring in 38.17 billion this year, which is a very healthy 4.9.6 increase over the previous 36.36 billion. Moving into next year, analysts have revenue climb another 4.19% to hit 39.77 billion. For a massive, large, mature healthcare company, a steady 4 to 5% top line growth is very acceptable. Earnings are projected to grow faster than revenue, which signals margin expansion and more suitable path for future dividend increases. Remember back to the earlier slide, we saw how the payout ratio is sitting a bit high. This projected jump in the EPS to 652 is exactly how Medtronic is naturally bringing down that payout ratio. As far as price targets, the bull case is 127.05. That's a 55.6% upside. The average price target is 109.66, indicating a 34.3% upside. And our current baseline is around 81.67, which is our current price. Looking at the 12-month Wall Street consensus, we see that the majority of the analysts, or 21 of the analysts here, are indicating a buy or a strong buy, 15 are on a hold, and 1 is indicating an underperform or a sell rating. Finally, the high-level rationale for me breaks down like this. Medtronic is a dividend aristocrat status, a dividend aristocrat. 48 consecutive years of payout increases, and they're on the cusp of becoming a dividend king. They posted resilient earnings, stable operational framework, a global portfolio delivering steady revenue despite localized headwinds. Corporate growth or secular tailwinds in robotic surgery, Hugo, heart platforms, and AI-driven tech. Have an attractive yield entry. That current dividend yield between 3.5 and 3.8% was just really attractive, and definitely was something that activated us. And then also, like Abbott, this is a mean reversion play. They're trading beneath their 5-year average or their median forward PE, so that to me that indicates a potential margin of safety. All right, guys. Thank you so much. I appreciate you going through this with me. Like I said, this is my personal rationale for picking up Medtronic and adding it to the portfolio. I don't know you. I want you to do your own diligence for anything that you do, and I wish you luck.